In this video, we're going to begin our discussion on stocks. Particularly, we're going to focus on methods to value stocks. You might turn on CNBC or open up the Wall Street Journal and see that Apple stock is trading for $116 per share, or Amazon is trading for $3,200 per share. But what do these numbers mean? What we'll see here is that those values aren't arbitrary. These prices have a direct connection to the fundamental time value money concepts we've been discussing previously. First, let's begin with a simple description of what stocks are. Stocks are equity securities. If a company wants to raise money, they can sell shares of stock. And those shares they sell, they represent ownership in the company. If I have one share of IBM stock, then I'm an owner of the company IBM. Companies typically have millions or sometimes even billions of shares outstanding. So if I have one share of IBM stock, I only own about 1/1,000,000th of the company. But I'm an owner nonetheless. And as an owner of the company, I'm entitled to a few things. For one, I would typically get voting rights. Shareholders cast votes on who sits in the corporation's board of directors, and they periodically vote on major corporate actions like whether the company should be a part of a merger or not. It's often the case that one share of stock represents one vote. Also, as an owner of the firm, I'm entitled to my portion of the company's profits, and these profits are distributed to shareholders in the form of dividends. A dividend is simply a payment made to shareholders, and it can be paid from the company's current year net income or out of the prior year's retained earnings. The corporation pays dividends from their after-tax profit, their net income. Therefore, unlike interest expenses, there's no tax shield for dividends. Dividends are not tax deductible, so paying dividends will not reduce the company's tax expense. And also, unlike interest on debt, the company doesn't have a legal obligation to pay dividends to its shareholders. Some companies, like Google here, make it clear that they don't plan on paying out their profits as dividends to owners anytime in the foreseeable future. Why might a company make this decision? Remember that there's two things the company can do with its profits. It can either pay a dividend or it can reinvest its profits back into the business. By Google taking the stance they have here, they're basically saying it's more worthwhile to reinvest the money back into the business than to simply pay out cash to the owners. Google may have many new, potentially path-breaking projects that it's working on, and investing in those will benefit shareholders more than simply giving them cash. This is the policy of many growing companies. More stable and mature companies lack the investment opportunities of a company like Google, and they're more likely to pay out dividends to shareholders. We're going to spend the rest of our time here determining how to value stocks. And I think a good way to approach this is to compare and contrast against something we should already be familiar with. That's bonds. First, some similarities. Both stocks and bonds are sources of funds, and they both make periodic cash flows to holders of those securities. Stocks will pay dividends, whereas bonds will make coupon or interest payments. Investors in bonds and stocks will pay some price today to purchase the security, and in return, they expect to receive some future cash flows. In terms of differences, bonds are a liability, they're debt. Stocks, on the other hand, are equity. Also, if you remember, bonds have a maturity or expiration date. They'll make periodic interest payments up until that expiration date. Then the contract is over. Stocks, on the other hand, they live on forever, or as long as the company exists. Stocks and bonds also differ in their characteristics of their cash flows. Coupon payments on a bond are fixed. You would get the same interest payment each period. The dividends on a stock, however, do not have to be the same each time. Dividends often change or grow over time. Now let's compare timelines. A bond's timeline would look something like this. Notice that the coupon payments are equal to each other, and that the timeline ends. That is, the bond contract expires at year 5. And there's a lump sum single cash flow that occurs at the maturity date. That's the face value payment. We can contrast the bond timeline with that of a stock. With a stock, the cash flow it pays off do not have to be equal. The dividends can each be different. Also notice that there's no expiration date for the stock. The dividends will continue on forever until time infinity. And there's no lump sum cash flow that's analogous to the face value of a bond. The only cash flow the stock pays off to shareholders are the dividends. With the timeline of a stock in our mind, let's try to develop a model to value them. We can start with the basic fact that there's only two ways you can get cash from owning a stock. One way is by receiving a dividend, and the second way is by selling the stock to someone else. There are no other ways that a stock security would provide cash to its owner. Next, we can revisit the idea that the value of any asset is simply the present value of its future cash flows. We use this when we value bonds, and the same concept applies here. To determine the value of a stock, all we need to do is find out the value today of all the cash flows we expect to receive in the future. And that's what these two formulas here are doing. Let's do an example. Say we have a stock that will pay us a dividend payment after one period. And also after one period, we sell the stock to another investor for a price P1. Putting this on the timeline, we have something that looks like this. If we own the stock today, we'll receive cash flows of D1 and P1 after one period. So how can we figure out the value of the stock? All we have to do is find the present value of the future cash flows we expect to receive. If we get the dividend D1 at time 1, we need to find out what that is worth today. And the same thing for the price we sell it for, P1. We receive P1 when we sell, and we need to find out what that P1 is worth today. So the value today of this stock is just the present value of the cash flows we expect to receive. Let's throw some numbers into this. Say you're thinking about buying more oil stock, and you expect to pay a dividend of $2 in 1 year, and you expect to be able to sell it for $14 after 1 year. If your required rate of return, aka your discount rate, is 20%, what should you be willing to pay? We'll put this problem on the timeline, and we see we get a $2 dividend and the $14 selling price at year 1. And to determine the value of the stock today, we just need to compute the present value of those future cash flows. The $2 we'll receive is worth $1.67 today. And the $14 we get after 1 year is worth $11.66 today. Adding these together gives us the value of the stock, $13.33. Now let's extend our time frame. Before we said we'd sell the stock to somebody else after one period. This time, let's hold it for 2 periods before selling. So we'll get a dividend after 1 period and another one after 2 periods. Then in period 2, we'll sell the stock to another investor for a price P2. The timeline for this will look like this. And the process to find the stock's value is the same as before. We need to find the value today of the future cash flows the stock will pay us in the future. Going back to our numerical example with more oil, say that after the $2 dividend we get in the first year, we get another dividend of $2.10 in the second year. And we expect to sell the stock for $14.70 after 2 years. The timeline would look like this. And again, to find the value of this stock, we need to just compute the present value of the future cash flows and add them together. The $2 dividend we get after 1 year is worth $1.67 today. The $2.10 dividend we get after 2 years is worth $1.46 today. And the $14.70 we sell it for after 2 years is worth $10.21 today, giving us a total value of $13.33. That's how much the stock is worth today, given these expectations. We should see a pattern starting to develop. So now let's try to develop a general model to value stocks. We'll call this the dividend discount model. In the examples we just worked, we needed to know what the price of the stock would be in the future, either 1 or 2 years down the line. But we have a problem there. It would be impossible to know the future price for certain. So it seems like we're stuck. How can we make this work if we don't know what the P1 or P2 is to put on the timeline? Well, we can keep extending those examples. Instead of selling after 2 years, we sell after 3 years, or 4 years, or 20 years, or 100 years. We can extend it all the way out to year infinity. Doing that, we would end up with this formula, which says that the value of the stock today is the present value of all the dividends the stock will pay from next year until infinity, and the present value of the selling price of the stock at year infinity. How does this help? Think about the selling price at that time infinity. How much would that be worth today? Well, we can't literally sell it 1,000,000 years from now, but suppose we sell it 1,000 years from now. 1,000 is quite a bit smaller than infinity, but it's going to get the point across. We sell the stock for $10,000 1,000 years from now. With a discount rate of 10%, that $10,000 cash flow is worth nearly $0 today. It's a really tiny number. Therefore, we can ignore the selling price at time infinity. It doesn't add anything to the value of the stock today. And we can say the current value of the stock is simply equal to the present value of the future dividend payments. So we solved one problem. We don't have to worry about the impossible task of knowing the price of the stock in the future. The value today is just the present value of the future dividends. But we're still left with another problem. We need to know the size of those dividends. What is the dividend we'll receive in each of those future years? We can get around this problem by making an assumption. We know the current or most recent dividend, what the most recent dividend was. You can get this information from Google Finance or the company's annual report. And we can make an assumption about the growth of future dividends. We'll work with two assumptions. The first scenario is a company in which the dividends paid are going to grow, but they'll grow at a steady, constant rate. We'll call this the constant growth model. The second scenario is one in which the company experiences abnormal growth in early periods, but eventually steadies out to a constant growth rate. We'll call this the non-constant growth model. We're going to deal with the constant growth model here and leave the non-constant for the next video. With the constant growth model, the dividends the company pays are expected to grow each period, but they grow at a constant rate of G% each period. Since we know the current dividend, D0, we can estimate the dividend next period as being G% bigger than the current one. So D1 equals D0 times 1 plus that constant growth rate G. The dividend at time 2 will be G% bigger than the one that came before it. So D2 is equal to D1 times 1 plus the growth rate. We already found D1 a second ago, so let's substitute it into this equation. And combining terms, we see D2 is equal to the current dividend, D0, times 1 plus the growth rate squared. Following the same process, we can find the dividend at time 3 as D0 times 1 plus the growth rate raised to the third power. And the dividend at any time in the future, time n, can be estimated as the current dividend times 1 plus the growth rate raised to the n power. We substitute those dividends into our equation from before that said the value of the stock today is just the present value of the future dividends. Instead, this time, I'll substitute the D1s and D2s that we don't know with information that we do know, that is D0 and the constant growth rate G. Lucky for us, this equation simplifies to an easy-to-use formula. We can say that the price of the stock today is equal to the current dividend, D0, times 1 plus G, divided by the required return R minus the growth rate G. This is the constant growth model for stock valuation. We can also write it another way. What does the numerator D0 times 1 plus G equal? That's just D1. So we can also write the current value of the stock as D1 over R minus G. There are a couple requirements we have to meet in order to be eligible to use this model. First, the growth rate of the dividends has to be constant. The G cannot be changing over time. And second, the required return must be greater than the constant growth rate of dividends. It should be clear to see why we have the second requirement. If it were not the case that R is bigger than G, then we would end up with negative prices. Now that we have a model to work with, let's put it to use with some examples. Suppose we have Purple Corp, which just paid a dividend of 50 cents per share. And we expect their dividend to increase by 2% each year. If the required return is 15%, what is the value of this stock today? First, we need to check if we meet the requirements to use the constant growth model on this stock. Is the growth rate of dividends constant? Yes, they're going to grow at 2% per year. Is the required return greater than the growth rate? Yes, 15% is bigger than the 2% constant growth rate. So we're good to go. We have our model here, and we need to determine which version of the model to use. The version we choose will depend on the information we have on hand. In this case, we're given information on the current dividend, D0, so we'll use that first version. Putting the information from the problem into the model, we get $3.92 as the value of the stock today. Let's pause for a second and think about what that $3.92 represents. That $3.92 represents the value today of receiving a dividend next year, the following year, and every year after that. We can do another example. Suppose AU Airlines stock is expected to pay a dividend of $2 next year. If the dividend is expected to grow at 5% per year and the required return is 12%, what is the value of this stock? We can check that we meet the requirements to use the constant growth model, and we do. The growth rate is constant and R is greater than G. For this situation, we'll use the second version of the model because we're given information of D1, the dividend next year. We don't know anything about D0, the current dividend. Putting the information into the model, we get a value of $28.57. That's the value today of receiving all of AU Airlines' future dividend payments. And we'll do a final example. We have Flatco, whose most recent dividend was $1.50 per share. And the dividend is not expected to change in the future. If the required return is 10%, how much is this stock worth? Again, let's first check to see if we meet the requirements to use the constant growth model. Is the growth rate constant? Yes, it is. What's the growth rate of dividends here? It's 0% because the dividends are not expected to change. And R is greater than our G of 0%, so we meet both requirements to use the constant growth model. You'll notice that if we put in the 0% growth rate for G in our model, it turns into the perpetuity formula, which fits this situation. Flatco is going to pay a $1.50 dividend forever. That's just a perpetuity. Putting it in our information, we get the value of the stock to be $15 per share. So this has been an overview of how stocks are valued. Hopefully now you see that the prices we see for stocks are not arbitrary, but instead are rooted in something fundamental, the time value of money.